Record numbers of so-called zero-day options that track the S&P 500 stock index and changing hands with volumes of about 1.5 million a day in November of this year, 2022, more than double the level in January, and almost four times those at the start of 2020, according to option metrics. Options provide the right to buy or sell assets at a fixed price by a given date. Zero-day options provide this right for the shortest period and expiring the same day they are purchased. While options trading has risen broadly since the start of the pandemic, a certain strategist at Goldman Sachs pointed out that ultra short dated options have been the strongest area of volume growth. He estimated that about 44% of S&P 500 index options that have been traded in the third and fourth quarter of this year, 2022, had less than 1 day to expiry. The vast majority of the volumes appear to be flowing from professional traders such as asset managers, hedge funds, and banks, not retail investors, according to their research. And one can imagine that trading such daily trading such zero-day options provides one with almost 252 bets or 252 strategies or 252 opportunities in 1 year. So buying a zero-day option is a way to gain exposure to intraday price moves with a potential payout in cash. Option sellers collect a premium to bear price risks for a relatively short period. So while traders tracking equities or equity indices may also purchase exchange-traded funds, which are baskets that hold individual stocks or own company shares themselves. Options are cheaper to buy, and the positions do not need unwinding after the contract expires. The contracts have been appealing in recent bouts of market volatility, allowing funds to focus trades on specific events such as monthly inflation data releases or days when the US Federal Reserve concludes its monetary policy meetings. Okay, so some have pointed to the surge in options trading as one propellant of the wild intraday market swings registered this year, 2022. Market makers that sell options contracts will hedge their positions to avoid making a bet on the market's direction. That hedging can at times accelerate broader shifts. If market makers sold a large number of call options that would pay out if the S&P 500 were to rise, for example, they could hedge their positions by purchasing S&P 500 futures. Some believe that index futures trading can in turn affect the prices of underlying stocks. As options activity goes up, this can create bigger swings, according to Gareth DeSimone, head of quantitative research at Option Metrics. He noted that a flurry of recent studies had led to widespread acceptance of the theory that option sellers' so-called gamma exposure could increase volatility, but said the point of contention is working out what is its influence at any given moment. Nomura analyst Charlie McElligott posited that some financial institutions had been behaving like full-tilt day traders, trying to weaponize the phenomenon to amplify and juice the intended directional market move. Traders used a similar tactic to create short squeezes and drive up the price of individual meme stocks last year, 2021. But the Simeon at Option Metrics believed that it would be much harder to do that at a sustainable level on an index just because of the size of the market. Strategists across Wall Street have been watching the rise of zero-day options for months, at first thinking it was driven by small day traders through online brokerage firms or accounts. But research from JP Morgan Chase indicated that retail accounts were not the principal factor behind this surge, as they accounted for just only 5.6% of trading in S&P 500 index options that expire on the same day they are purchased. The name zero-day options can be confusing, as the actual derivatives have been traded as weekly contracts that are bought or sold on the day that they expire. Exchange operator CBOE Global Markets, in attempting to capitalize on the boom in options trading, has spurred momentum in zero-day options by offering new products this year. These include weekly options on the S&P 500 index that expire on Tuesdays and Thursdays that complement products that expire on Mondays, Wednesdays, and Fridays. This means that investors can trade large sums of options that mature each day of the week, including a zero-day options when they are on the cusp of expiring. According to Amy Silverman, a strategist at RBC Capital Markets, she indicated that the shift to use options, including ones that expire on the same day, was in part due to the fact that many investors lacked real conviction in the market's direction and have reduced leverage. But fearful of missing out on an unexpected rebound, traders have turned to the weekly options, given their relative cheap costs. So the content in this video relied largely from the piece written on Friday, the 2nd of December 2022 of the Financial Times, titled "Fund Managers Flock to US Equity Options with Fleeting Lifespans." So see what you make of zero-day options, and thank you very much for watching this video.